Welcome on board very quickly, Rajeev Gupta, the CFO at L&T Technologies, and ask them about how their quarterly performance has been. Rajeev, great to have you on the show. On the Q4 numbers, or rather the call, you had said that automotive-led decline in SWC should be lower or not there. In Q1, did that play out, or did automotive as a segment surprise again?
Before answering, let me give you a little bit of color of Q1 FY27. So Q1 FY27 actually has been a very good quarter for us. This is a quarter where LTTS strategy is showing up in terms of numbers. All the strategic actions that we had planned over the last several quarters are actually beginning to yield outcomes. Our revenues in Q1 FY27 grew 11.5% year on year to INR 2,940 crores. Our EBIT margins went up by 200 basis points year on year to 15.7%. Our net income went up by 17.4% year on year, and all the sequential growth in revenue and margins have been despite an uncertain global environment. In addition, we had large deal wins of $100 million. 50% of those large deal wins have been in mobility. So what is giving us confidence is, alongside a strong order book in sustainability, mobility also is starting to look good, right? And in fact, we've seen a growth in this quarter in mobility. To your specific question, mobility now stands at an annual run rate of $401 million, a 2.3% sequential growth. So it's now beginning to look better. And our growth has been broad-based, which is led by aero, rail, truck, and off-highways. And we're also seeing momentum in North America auto. So this is how I will share about mobility.
Right. You guided to sustain about $200 million plus quarterly large deal TCV, and it is inching it upward as well. Did Q1 deal wins 130 million, 120 million, 410 million plus meet that bar eventually? And is $200 million plus now the new base?
Appreciate your question. And we maintain that we would like to do $200 million plus large deal wins in the quarter. In fact, this quarter we did $100 million of large deal wins. Now, there was one large deal that we had to close in Q1, and that moved to early part of Q2. Had that come in, we would have done more than $200 million. And you will see us announcing this in the maybe coming weeks. So we remain positive. There are quite a few large deals that we have in the pipeline and good traction. In fact, I would like to add some color. Why do we remain so confident about large deal wins? In fact, LTTS is evolving from engineering services company to engineering intelligence solutions company. At LTTS, we believe the next decade of engineering will be defined by convergence of engineering domain expertise, software, data, and AI. So it is no longer about designing products. It's going to be about designing intelligent systems. And at LTTS, we've called out the 6-layer AI cake, and this is for real. There's energy, chips, infrastructure, data engineering, models, applications. And we have the ability to play in 5 out of these 6 layers and offer solutions to our customers. We've also gone into partnerships with the Anthropic and Databricks in this quarter. So we feel fairly comfortable that the engineering intelligence capabilities and solutions that we build will help us deliver larger deal wins and, of course, growth that we can sustain in the coming quarters.
Right. But you had flagged off margin improvement into Q2, Q3 as well as headwinds phase out. With your EBIT margin already up this quarter to about, over 15.5%, are you running ahead of that internal trajectory?
What I will share is probably a near-term outlook and also a longer-term outlook. In terms of margins, I would still guide that we aspire to get to mid 16% levels on or before Q4 FY27. So indeed, if there's an opportunity, we would like to deliver mid 16% levels before quarter 4 FY27. But at this stage, I'll maintain on or before Q4 FY27. Having said that, we are committed to our longer term aspiration of 13 to 15% revenue CAGR over the next 5 years and maintain EBIT margins between 16 to 17%.
Right. And your dollar revenue growth was just about 1.5% sequentially, 1.9% year on year in constant currency terms. Is this consistent with your FY27 growth aspiration, or does H2 need to accelerate meaningfully to hit the full year targets?
See, I will tell you a couple of things on this, right? One is, if you look at the portfolio mix that we have across sustainability, mobility, and tech, sustainability, we've got a strong order book. If you see sustainability, it now is at an annual run rate of $460 million, a sequential growth in Q1 FY27 of 4.3% and 11.3% year on year growth. So fairly strong. We believe sustainability growth will continue in the coming quarters. In addition, with mobility looking healthy in terms of growth, which is now clocking $401 million ARR, it was a 2.3% sequential growth. And this was a broad-based growth, right? It came in aero, rail, truck, and off-highways. And like I said, in North America, auto also we saw growth. Now, why do we see mobility to be positive for us is because LTTS has got a diversified strategy, which is across businesses and across geographies. Lastly, tech, it's at a $379 million annual run rate. So if you look at it, given the strong growth of sustainability, mobility looking positive, and of course, the portfolio mix that we've got in tech, we remain fairly comfortable that there will be sequential growth coming in the next quarter, in the next few quarters of FY27, and of course, improvement in margin as well.
Right. And is the 16% plus EBIT margin a realistic kind of exit rate target for FY27? What's the single biggest swing factor? Currency, wage hikes, deal mix? What's going to likely play out?
I would say three things. One, it's growth and quality of revenue that's giving us the comfort that the margins will continue to improve. Second, the segment mix. Sustainability now delivers a very, very strong EBITDA, followed by mobility and then tech. So an improved segment mix in terms of growth and profits helps us in terms of achieving the overall EBIT margins. Third, if you look at operational excellence and the SG&A part, they have actually, the SG&A has improved by 80 basis points. And we feel that we'll be able to optimally manage SG&A going forward as well. So those are the three primary reasons we feel that we'll be able to achieve mid 16% levels. In terms of exit, I will call it out in the coming quarters. At this stage, what I'll maintain is we would like to achieve mid 16% levels by or on or before quarter 4 FY27.
What about the likes of Claude, Anthropic? The integration is now live across 5 platforms. How much incremental revenue or margins uplift do you anticipate from this in FY27? And is it a wrap on existing contracts or driving net new AI native deal wins for you?
So if you look at the partnership with Anthropic and also I'll include Databricks, this is strategic for us. Our pivot towards developing LTTS to become an engineering intelligence solutions company. Anthropic, we will actually integrate cloud in engineering processes and also leverage LTTS platforms. We've got platforms like Agentic IQ and Plus AI, where we will integrate a lot of these solutions. And we will be able to offer some of these solutions to our customers. So yes, it will bring us incremental revenues and also help us to leverage on partnership that we develop with Anthropic.
And give us a sense, top 5, top 10, top 20 client concentration largely flat. Is diversification an active strategy priority, or you're okay with how things are playing out in terms of mix?
See, if you look at the top 5, 10, I mean, these are accounts that have been consistent with us. These are long-term relationships. And if I would call that, these are opportunities for us to be able to position our engineering intelligence solutions to many of these customers and then be able to see revenue growth and help them adopt AI. In fact, I will call out that we partnered with MIT Media Labs to run AI readiness workshops, and we've already done that for a few customers. That this allows AI readiness index, where a customer can understand the readiness of AI adoption. So many of these customers actually provide the opportunity for us to position our engineering intelligence solutions and capabilities.
And what's the single biggest swing factor, positive or negative, for LTTS heading into the next quarter, Q2 that is?
So one, I would say we've got a good start to FY27 with a strong quarter that we've come into. I think that momentum continues with a good order book in sustainability. Mobility now looking positive with growth coming in Q1. And tech, we believe with the pipeline that we have, all these three segments should fire for us in the next coming quarters. We've seen margin improve in the last 3 quarters, and we will maintain this trajectory going forward as well. So all in all, I think the bets that we placed, the strategy that we set up, it's kind of playing the outcomes that we desired for.
Okay. Thank you so much, sir, for coming in and giving us that perspective. That's, of course, LTTS with regard to its numbers. What we'll do is simply quickly go into break, come back. On the other side, we'll have the management of KC International. The stock is perked up on the back of that 1,100 crore order win in the data center space. We'll talk about that with the management. Stay with us.